Hello and a warm welcome to Talking Stocks. I'm Gugulethu Cele. Also in studio is our Anchor Capital guest, Peter Armitage and Sean Ashton. They're both from Anchor Capital to give us their expert insights into analysis into both JSE and global listed companies. Now today we're talking about South Africa's largest building supply retailer, Cashbuild. The company has been listed on the JSE for almost 30 years. Good to have you both, gentlemen. Now, Sean, usually when we think about Cashbuild, it's one of those stores that one often wonders if it is really quite a strong profit driver. But give us more perspective into the company and its supply to South African consumers.
Sure. So Cashbuild is, as you mentioned, the largest retailer of building materials and related products in South Africa. A large part of their customer base is in the outlying rural areas, so you will often find that a lot of these stores are located outside of the major metropolitan areas. And really what this company should benefit from over time is the formalization of housing in the country. So as you see these traditional township type developments where there might have been a tin roof before, increasingly proper brick houses with tiled roofs, Cashbuild should capture all of that business over time, and they've done quite well in capturing a lot of it to date.
I understand it was listed back in 1986, so surely this means it might have stood the test of time and has around 218 stores allocated across the country. Yeah. Quite a footprint there.
Sure. Yeah, and I think it's important to realize that the footprint didn't grow materially in recent years. I think management probably became a bit gun-shy about the environment having been quite soft, and I think arguably a couple of years ago they lost a bit of market share to Spars Build It, but you're seeing a bit of a rejuvenation in their build-out of their business. So recently their footprint has accelerated by probably 10 to 15 stores per annum over the last year or two. So between kind of 5 and 7% space growth from a store perspective, which is quite strong.
Peter, when we look at the metrics, do they make sense, especially given the fact that it is facing quite a bit of competition? I think Massmart's Builders Warehouse is also one that supplies similar products as Cashbuild does.
Yeah, I think it's a slightly different model. Builders Warehouse tends to be quite a lot bigger. They typically Massmart's format is bigger stores where they try and get the benefits of critical mass. Cashbuild are prepared to have a smaller store. They've got smaller store formats in the smaller areas. And it's unlikely that Builders Warehouse is going to go and replicate a 240 store footprint. So there's still opportunity for growth. And another interesting thing about the business is you've got it was a high flyer on the market for many years. It was growing at 30-40% for quite some time because it's a model that works. I mean, it's quite predictable what a new store will do. So they've got this model which is a nice return. It's all in cash, as the name suggests. So they never had any of the kind of credit worries. And they've had that model and stamped it out for many years. You then have a lesson we can learn from all companies where the chief executive officer of the business can determine what happens to the business. And as he got closer to his retirement, he became more conservative and they stopped opening new stores. And as Sean was indicating, the new management came in and they started with a breath of fresh air and said, let's get started on the new store growth again. So you had Cashbuild flatlining for quite some time as the growth was quite stagnant. But I think re-entering quite a nice growth phase.
It's interesting because you also allude to where the capex spend is almost made back in less than 2.5 years with regard to the cash generated from its new stores.
Yeah, I mean, depending on location, a typical store should have a payback period of 2 to 3 years, which means that the business model itself should generate a 30% return on equity over time. So it's a very, very high return business model. Fast payback on capex itself, and your capex is really limited to store fit out. They'll tend to lease a lot of the premises that they operate from, and it's a capital light model in the sense that you, as Peter alludes to, you don't sell on credit predominantly. I mean, they do have some third party credit, I think through Nedbank that used to supply, but really their sales are cash sales, and your stock tends to be largely funded by creditors. So the working capital cycle is very, very short and it tends to generate a lot of cash. So earnings principally convert into cash. There's not much working capital investment.
When we take a look at profit drivers, the store's revenue contribution, I see 2013 did take a bit of a knock. There was that part of the macroeconomic environment in South Africa.
Yeah, I think the environment was quite slow. Their volumes, if I recall, from that particular year were actually down. They probably had a bit of inflation, but volumes were down in real terms. And what you're starting to see now is a combination of quite strong store rollout. So the last reporting period, new stores would have contributed about 6% to revenue growth. existing stores probably another 6% or so, of which half would have been inflation and half would have been volume. So it's never been a business with huge product price inflation coming through the base. They obviously try and control the price increases. But it's encouraging to see some volumes returning to not only new stores, but existing stores as well. And that was a challenge that they faced a couple of years back.
When you look at the volumes versus inflation, is that an area of concern maybe?
Not really. I mean, it's broadly evenly split right now. Yeah? So as long as you can get 3-4% volume growth and a bit of inflation into your stores. Yeah, the trick for this business is that most retailers with this type of model, your single biggest cost is people and the leases that you have in your stores. And those costs tend to run at kind of 7 to 8% escalations per annum. So you want to be running your business model should run at that kind of trend rate of growth in terms of same store sales growth. If you're not managing to get there, you could have a bit of a margin squeeze. And as we know, brand new stores are quite profitable. So as you add new stores, so your turnover growth is quite strong and your profit growth is strong. You just don't want to be stagnant in this environment in terms of not adding new stores. Then you start going backwards.
Pete, I'm sure you agree. And is it clearly a model that works regardless of how the consumers are under pressure? Because we always hear about those trends.
Yeah, I think, they started off really at the bottom end of the market, so servicing the lower LSMs. And there's in South Africa, you can have quite different dynamics from time to time in terms of the different segments of the market. Where inflation sits, who's got debt, the micro lending crisis had an issue at a certain segment of the market. They've more recently moved into and opened stores in the more affluent areas, so they're a bit more exposed to the kind of credit cycle at the top. But what you tend to find is, the kind of rump of their business, the core customer, is one who has started a house, is slowly adding on to it, is allocating some money every month to a bag of cement and some bricks and, adding on a room and developing. And that trend we think will continue for many, many years. And that sort of spend, quite a bit of it is, some of it is grant money, it's guys sending money back home. And once somebody started building, that can slow down a bit, so you can have some cyclicality. But we quite like, it's your typical, the foreign investors have always liked it, because it's kind of quite a nice emerging market share, where it's the story of the developing lower class moving into the middle class. As they start to create a bit more wealth, they've got a bit more discretionary spend, they're developing their asset, they're developing their house. And you can kind of picture why that would continue for quite some time.
It does have a very strong SA focus, but would venturing further into the continent be something that management would obviously want to pursue and would make sense from an investor's perspective? It
is, but it's, moving into Africa is always an interesting one. The management said to us a few years ago, I remember that if moving up into Africa, it's a big risk. You don't know how big the footprint is. If you've got a store in South Africa, you can pretty sure of what the cement supply will be, where the steel will come from. It kind of all works. So, they're saying there's still an opportunity to open 50 stores within 100 kilometers of their head office in Johannesburg. And I think the inclination has been it's a lot easier, a lot more predictable to open South African stores. But they haven't had their eyes closed to Africa. They have opened some stores and they moved up north. But there's probably still going to be more growth out of South Africa than Africa. But if you take a 10-year view, I guess the business could be quite differently positioned from an African perspective.
You did touch on the margins that they manage, Sean, just a moment ago, as well as the biggest costs, that obviously being people and the leases that they have involved. But what about their balance sheet? Is it fairly lazy?
The balance sheet's very lazy. It's been a criticism that we've had of the group in the past, in the sense that, on the face of the balance sheet, you'll see R1 billion worth of cash, which looks very high. In reality, it's probably closer to an average figure of 750 million rand. If you just look at the interest that they're earning on their cash at any given 6-month period. But certainly, they could distribute a lot of that cash to shareholders. It's roughly 32 rand a share. To put that into context, the share price is 230 rand, so more or less 12 to 15% of the value of the company is actually net cash. I think that this is a very conservative management team. They will tell you that they want to retain a lot of the cash for growth. We actually think that the realistic path of store developments can be funded through internally generated cash flows as well as the dividend flow. So I think that that's a number that's unlikely to shrink. I think that cash balance will only grow. And unless they become a lot more generous with dividend payouts or declare a special, for example, I think you're going to see that cash building up. And we don't typically like to see very lazy balance sheets. We like capital management companies that are active with capital management. But certainly buying back shares is not really an option for these guys, in the sense that the liquidity of the companies or of the share itself is relatively tight as well.
Why is that, Sean? There's no real major shareholder from what I can recall.
Yeah, there aren't really any major shareholders, but from a market cap perspective, it's still relatively small. I mean, we're talking about a 6 billion rand business today, and that's after the share price has run the way it has. So this is still a small company in the context of the overall market.
Let's talk about that share price, because I understand that you didn't expect it to breach 200 rand a few months ago, and just over a year ago it was sitting at 118 rand.
Yeah, so it's run significantly, and I think a lot of that is as a result of results having vastly exceeded people's expectations. So when you look back a year ago, I don't think anybody was forecasting 30% growth for this half year that we saw. And actually the second half, they've given a sales update which indicates sales growth ahead of what we saw for the first half period. So if anything, the full year will be a lot better than you saw at the half. And obviously when you're operating at a 5 or 6% operating margin, if you can keep your costs below the 15% or 12 to 15% turnover run rate that you're achieving, there's significant leverage to be had. I think a lot of that is starting to be priced in the sense that this is a business where the margins have been cyclical over time. It got to a low of about 4%. But by the time they report 2015 results, we think that their operating margin will be closer to 6.5%, which is about the high over any meaningful measurement period in the company's history. So I think they're getting back to peak margins, and then it's about, can they actually sustain the top line growth and the new store openings. And it trades at about a forward 13.5 times P multiple now, which is still not unreasonable.
Not unreasonable. Well, that does bring us to the time where we ask our experts whether to buy, hold or sell the stock. Pete, let's start with you. Buy, hold, sell, Cashbuild?
I think we'd put a buy on it, but it's not a racy share. It's not going to race away. We don't expect 40% returns out of it. But a nice dividend yield, a nice predictable, core, uncomplicated business, getting high returns, will deliver profit growth over the years, a nice trend. So for investors looking for that type of share, we think it's quite attractive.
Sean, I take it you agree as well?
I think the easy money's been made. I mean, I always hate defaulting to a hold because it kind of feels like you're sitting on the fence, but I think it'll deliver returns more or less in line with the broader market, would be my sense of things, given where the valuation has come from and where it's got to. And you've just got to be a little bit circumspect about the fact that margins are back to peak levels this year, and we know this has been a cyclical company over time. So I would call it a hold for now.
And your thoughts on management, despite their laid-back approach?
Yeah, I think they're solid, hey? Yeah.
They've grown up through the business, so it's they know it. It's a simple business, they run it well, and they're stamping out the model.
Understand it through and through. Well, that's what we've heard on Cashbuild. It certainly does come through as a buy from our experts today, from Peter and Sean. Well, that's where we leave it for this week on Talking Stocks. Do join us again next time.